What happens when things go wrong? The market tanks, vacancy drives up, rents plummet. Is your investment ruined? In this video, I'm going to walk you through how to stress test your multifamily investment to save you from losing sleep at night. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investment podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about stress testing your multifamily investment. First of all, what do I mean when I say a stress test? Well, quite simply, we're just looking to see how the multifamily property will perform in an economic downturn, in a recession, in a market crash, however you want to say it. So we're adding stress to our underwriting model by really making a worst case scenario to see if our investment underwriting and our model and our business plan can sustain those pressures during economic downturns. And this is exceptionally important because, as we all know with real estate, it's a cyclical type of market. So we have our real estate market like this. And this happens time and time again. A market cycle, generally speaking, you can say between 8 and 12 years. You have your period of expansion, so you have your peak, then you have your market slump, and then you have your market recovery. And this happens over and over again. And if you're holding a multifamily property, chances are you're going to be experiencing maybe 3/4 of a cycle, maybe a full cycle, depending on your business plan and how long you are holding on to this property. So you have to be prepared not only for the good times up here, but also for the bad times. And this is where stress testing comes into play. So what are some things we have to keep in mind and take into account in our underwriting to factor in an economic downturn and a worst case scenario to see how our property performs? First of all, we have to think about vacancy. And there's two types of vacancy, and I've talked about this before. We have economic and we have physical. And in a worst case scenario that we're planning for, we have to factor in vacancy rising for both. So physical vacancy, this is quite easy to understand. So is somebody occupying the unit? Yes or no. If somebody's occupying the unit, then the unit is occupied. But if it's unoccupied, it's empty, well, the physical vacancy goes up. So in an economic downturn, vacancy is going to go up, occupancy drops down, so we have less people filling our property. Now, this is where economic vacancy comes into play. Somebody may be occupying the unit, but they may not be paying us rent. They might be behind on the rent payments. Economic vacancy measures how much money we're generating from that unit or the property in itself. So somebody may be occupying the property, so physical vacancy may be at 90%, but if a number of people aren't paying their rent, it's going to be different. Economic vacancy will be different from the physical vacancy because we have less rent coming in. So economic vacancy also goes up because in hard economic times, people will lose their jobs, money gets extremely tight, and we may not have the rent collection that we had during the peak period of the market cycle. So whenever we're looking at multifamily stress testing, we have to keep in mind that economic vacancy will go up because we're going to be receiving less money. We won't be collecting as much rent. Maybe we have a collection rate of 98% when everything's good. Well, that may drop down significantly in hard economic times. So physical vacancy and economic vacancy. Now that we've looked at our vacancy, we have to look at how vacancy is going to impact our property because we need to fill up these units, but there's less people renting, there's less demand. So what do we have to do? Well, first of all, our advertising and marketing budget is going to increase. So we have less money coming in, but we have more money going out the door in our marketing and advertising campaigns to attract leads. So our cost per lead increases. And if you're a marketing or advertising or business person, you will understand cost per lead. So the cost of having somebody come in and express interest in renting a unit in our property will go up. Also, we have our leasing costs. Depending on how your property management is structured, leasing costs will most likely go up as well. And then we have incentives, also called concessions. What these are incentives that we offer prospective tenants when we have these problems of filling up the property to have them come in. So it might be first month of rent free. It might be free cable. It might be including all the utilities that were otherwise put on the tenant. All of these things are worked into our marketing plan to make sure that we're getting people into the property and we're able to lease it up. But what happens? If we have our physical vacancy going up, economic vacancy going up because we're collecting less rents and we're putting out more money to attract a tenant through our advertising and marketing, so our cost per lead goes up, our leasing costs go up, and now we're giving back discounts. So maybe you're saving 25% on your first 3 months. Maybe if you renew your lease, we're going to give you a $100 discount a month. Whatever it is, we're now absorbing more costs. So we have less money coming in, and now we have more costs going out. So we have to factor this into our underwriting model to make sure our property and our business plan can absorb these types of things. It's one thing to acquire a property when things are great at the top of the market, but you have to understand that as the market goes down, as it always does, we have the up and the down, contraction and expansion. We're going to be dealing with these issues. Now, every downturn is not the same, every market is not the same, but you have to be planning for this worst case scenario to make sure that you can still keep the property afloat and your head above water. Now let's talk about debt. And as I've said before, bad debt can sink a great deal. And debt is very important. And I want to talk about two types of debt as it relates to stress testing your multifamily investment. The first is bridge debt. Bridge debt will be used, let's say you're acquiring a property and it needs some work, it's a value add play, and you just need a temporary stopgap of, let's say, 2 years, 24 months of this more expensive debt, but it allows you to get into the property, do your work, and then you'll acquire conventional debt with a lower interest rate. So this is really a stopgap measure to get you into the property. You're paying more for it, but it's more flexible. You're just paying for it in terms of higher interest rates, but it allows you to get into the property, fix it up, and then you're going to finance it conventionally with different debt for the long-term hold. When you have bridge debt and you're implementing your value add plan, what happens if you have an economic downturn as soon as your bridge debt is about to expire and now you have to roll it into conventional? And there's no way you're going to read conventional there because it's sideways. So what happens if the worst case scenario occurs when your bridge debt is coming due? This is extremely important because if the market tanks and conventional debt is hard to get, and then you have all of this stuff happening, so you have less money coming in, your vacancy goes up, your costs go up, is your business plan, is your property able to survive this? And are you actually able to qualify? Will a lender give you conventional debt even though we have the downturn, we have a recession happening, the market, everybody's selling off? Are you able to still move from your bridge debt into conventional debt? This is something that a lot of people don't think about. They just assume, okay, well, I'm doing this business plan, I'm implementing my value add strategy, and I'll put a link right up here to a video I did explaining the value add strategy, but they don't think about bad things happening as soon as they're making the transition from their bridge debt to conventional debt. So I would strongly urge you to think about this and working into your underwriting. Whenever you have bridge debt, assume that the market is going to tank as soon as you have to move from bridge to conventional, because at least that way you're safe and you're not going to be losing sleep at night. The second thing I want to talk about is refinancing or a refi. Let's say you've acquired a property and you've implemented your value add plan, and you are planning on refinancing in year 2 or year 3, and you've worked this into your underwriting model. What happens if you're not able to refinance the property in year 2 or year 3 because a worst case scenario is happening and you can't qualify for the debt? Lenders are tightening up their restrictions, they're not willing to refinance at a higher value. What happens to your returns? What happens to your business plan and what you've promised investors if you can't make this refinance happen? What if you can't return to the investors the 30% of their capital that you promised them because you worked refinancing into your underwriting model? You have to take this into account and really ask yourself, if all this bad stuff happens when I go to refinance, is that possible? Am I going to make it happen? yes or no. If there's a question mark there, maybe you're better off keeping the refinance as would like to have, not a must-have in your underwriting, and keep it as a bonus to your investors and not actually working into your underwriting and your business plan. So all these things will happen. You have the ups and downs of the real estate market. You just have to plan for it, and the stress test is your way of making sure that your investment can weather the storm. And if you're interested in learning more about multifamily real estate investing, join our free Facebook group. It's a great group of people, so I'll put the link right down below this video. And if you are an accredited investor and you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. I really do appreciate it. And until next time, happy investing.